Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Trump's pick for Treasury Secretary and how that could affect mortgage rates. We'll also talk about housing starts and purchase applications. First, I want to thank our podcast sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast, and we have such an interesting topic today.
Sarah Wheeler, is just whenever you get a new president and you just get tons and tons of questions. And I encourage everyone, if you really wanted a more comprehensive take on Trump's policies, maybe tied to housing, Sarah and I just did a podcast about 2 weeks ago. We go into the kind of the broader impacts or things that can impact or can't impact. But today's topic is going to be something in that category, but it's more on the Treasury side.
It is on the Treasury side. So we have been waiting for a Treasury pick from President-elect Trump. Haven't gotten it yet. Why do you think that is?
And so this is Wednesday morning that we're talking. Maybe by tonight he picks Kevin Warsh or something in the morning happens. But I'm going to try to connect the dots right here. So understanding that my premise is that President Trump knows, and the people around him kind of know, that they can't let bond yields or the stock market or business investment go kind of astray, similar to what happened in 2018 and 19. And when Steven Mnuchin, the former Treasury Secretary, when he talked about, we would like to see a cap, meaning the 10-year yield won't go above 450. Which means that I believe President Trump is trying to get a loyalty pledge from whoever is going to be Treasury that you are going to support kind of the tariff thing by opening a yield curve control. I'm going to try to make it simple, that the Treasury's job is to make sure the 10-year yield doesn't go above 450. And that if need be, they need to lower rates to maybe get housing going if there's going to be some disruption on the business cycle with tariffs, similar to what happened in 2018 and 19. Because once the trade war tap dance ended, the economic data got better. I encourage everyone. I wrote an article about this right before COVID. We listed a series of economic data lines that were improving toward the second half of 2019 and the first 2 months of 2020 that everyone forgot because you're not a nerd like me. And here, I think he's trying to make sure that he has somebody there that'll support that, which is going to be a little bit different than Janet Yellen's take on this subject. So I think that's been the delay. And the first round of people probably haven't given him that. And I think Kevin Warsh right now is going to be interviewed today for the Treasury, even though he was talked about maybe replacing Powell. So I think that's the holdup. And look where we are right now, the 10-year yield, that tug of war, right? I mean, we haven't been able to break over 450, but we've just been back and forth at this level here. You know, that downtrend from 5% is still intact. You know, the Instagram family, which is now over 500,000 people come every 30 days. That, you know, it becomes an interesting tug of war. And I think he knows he's going to have to pick someone that will make the markets happy and also will fit his agenda over the next 4 years.
Okay, so imagine you're sitting out here, you're a loan officer, you're a real estate person, you're just, you're in housing in some way. What does that mean for me? So say if he gets that cap from somebody, what does that mean for me?
First of all, the worst case scenario of what a lot of people remember, a lot of conservative Wall Street, Druckenmiller, we're talking about 5 to 6% 10-year yields, mortgage rates 8 to 9%, stuff like that. That basically will go away. Now, you're going to need cooperation from the Treasury and then cooperation from the Fed, to make sure something like that occurs. But also, I think that, the housing starts data came out. Permits are at recession levels. Starts are at recession levels. It's pretty not late in the cycle, but job growth has been slowing down. Any kind of shock into the system at this point can take you into a recession, meaning jobless claims could go up. So if you're a housing person and this is actually the legit thing, it's a positive in a sense that they're very mindful that they don't want the 10-year yield to go above 450 or rates to go up higher. And preferably, they would like to have rates go lower. So that's a positive in that sense. This is my assumption. This is just what from Mnuchin said and what I tracking, especially 2018 and 19 economic data back then. I think that is the game plan. I think that's part of the reason why there hasn't been a pick just yet. He needs to make sure that he's got the person on his side, especially at this stage of the cycle.
So you and I talked about this earlier in the year when Trump said something like he thinks that the president, whoever the president is, should have control over the Federal Reserve and what happens with interest rates. Remember that podcast probably 6 months ago now? And you're like, no, that can't happen. Whatever, that's not going to be the thing. So, given the scenario, and you just said that he's looking for that cooperation, what do you think?
That's not the Federal Reserve, though. This is the Treasury.
I know, but you said that the Treasury would need cooperation from the Fed as well.
Well, the Treasury can override on certain things where the Fed can't. So if he was putting someone in, let's just say Powell resigned, and he was looking for a Fed chair. Okay, the problem is the Federal Reserve has a board of members, right? It's not just one person. A Treasury is one person. So you can have more power picking a Treasury person than the Federal Reserve. He can't really do anything to the Federal Reserve. And he knows this. This is why he basically said, I'm going to have Powell, play out his hand. So now if the Treasury says to the Federal Reserve, hey, listen, we think we need to do this, and the Federal Reserve members go, well, we're worried about inflation. Well, the Federal Reserve kind of already said in their work in 2018 that they don't believe fighting tariffs with interest rate hikes is a positive, because they found their work to say that's going to lead you into a recession. That goes against their dual mandate. So there's already a framework to handle this. And again, tariffs aren't inflationary in its construct. Like if you guys go back and look at the CPI or PCE inflation back in 2018-19, we didn't have like inflation take off. They're kind of a one price hit. But the problem is if it's a tit for tat and then you get into a trade war, there's where it becomes problematic. So getting the Treasury to kind of commit to a kind of a yield curve control or trying to make sure that there's a cap, there at least you have a better framework of what the Treasury can produce. Powell and the Fed members are going to be completely different, but at least the Treasury and the Fed can talk together on something in that regard. And this is just my theory on why it's taking so long, because there's a lot of, all the candidates were there. Everybody kind of had who they wanted to see, and nothing's been picked just yet. I always fall back to what Steven Mnuchin said. We would like to have a cap at 450. So I'm just wondering if that's the holdup right now. Has he gotten a pledge from anybody in the Treasury to say, hey, listen, I don't care how much you have to spend, don't let that 10-year yield get above 450.
So when did Mnuchin say that? Just for context.
Like a few days ago.
Okay, so
I don't watch business TV. So somebody just literally sent that to me because we talk about that key level right here. Because at this point of the stage, let's just do a hypothetical. Let's just say the bond market freaks out for some reason, and the 10-year yield goes up. Well, at this stage of the cycle, it's not something you want to deal with when the Fed is cutting rates at this point, because then the focus will be on him. I don't think he wants that. I think he just wants to get into it and get the cycle going. So it's one of these, you got to thread the needle because you want to do tariffs and you knew the tariff was disruptive, but you don't want the stock market to go down and bond yields. So I think he's just trying to find a Treasury person that is more in line with his policy.
Could be good for people in housing if we do get some sort of cap, right?
Well, cap also, honestly, if the economy got weaker, then it would be, in a sense, beneficial for housing. Because remember, labor over inflation, right? Not a Fed, whether the whole stance was in 2020. The Fed won't really pivot like people want them to until the labor market breaks. We've got a baby pivot. We got them cutting rates, but right now they're like, I don't know, maybe we should slow down. They're kind of in that stage. So, and we're sitting here with the growth rate of inflation, like the last PCE print headline was at 2.1%. but rates are at 7, right? And I just think a lot of people were told that if the growth rate of inflation falls, mortgage rates will go under 6%. Well, if the labor data gets softer, you could probably see 6%, sub 6%. Me, it's you need the labor market breaking. You need the economy to grow below trend. You need that for the next stage, and that was the Horner line at 380 on the 10-year yield. We just weren't getting that kind of data. That's jobless claims, consumption on the GDP prints. We're not getting those next stage levels that could get rates down there. So I think now most people understand that, now that we're almost in Thanksgiving and mortgage rates are at 7%, even though the growth rate of inflation fell, even though the labor market is getting softer, we're still in that range, for the 2024 forecast. And of course, some of the economic data was surprising. I mean, retail sales has surprised everyone the last few months.
Okay, well, listeners, make sure you're checking HousingWire, because I can tell you that newsroom is looking like a hawk to see if we get the Treasury Secretary named and the HUD Secretary, anything to do with housing. They're still watching really closely. And I know, Logan, you will also have things to say, so we'll have to talk again on that. Right now, though, I wanted to bring up housing starts.
Yes,
which you wrote about yesterday. Really great article. Why we will not be building millions of homes. It was good.
So of course, like I've always said, in 2021, when people said we're going to have a construction boom, and I'm like, no, you're not. Eventually, at one point, rates are going to rise, demand's going to fall, and we're going to sit here and have this conversation today. The unfortunate reality. We're already behind the curve on housing production. This is something that we talked about in the article. It takes time to get things going. You're looking at 2 years plus when a permit starts to get issued to start getting that process and finishing. Like, we're still finishing 5-unit constructions that started 2 years ago, right? And already permits are so to get that curve. It's just it's going to take. We're already behind it. Single family permits were falling, and then rates fell from 7.5% to 6%. If that didn't occur, the data would have been worse. So hopefully by now, this is to all my yes in my backyard, people, you need monetary policy, government policy, state, local, everything to kind of work together to get homes. And it's just rates are too high. And we've already passed the limit. And part of this was President Neil Kashkari, Minneapolis Fed.
I know you love it when he says things.
The gift that keeps on giving. So there's a link to a Bloomberg article, interview in there. It starts around the 11-minute mark. I encourage everyone to go listen to that. President Kashkari studies housing cycles. And because of that studying, he thought, well, housing demand is high. Because housing demand is so high, we need a higher clearance rate or higher mortgage rate. So I sat there and I'm thinking, okay, Minneapolis Fed follows my work. So I know the staffers are listening. It is the 3rd calendar year of the lowest existing home sales in the history of America. It's not like we have underwater mortgages. It's not like credit is tight. It's not like our demographics are bad. Demand is down. Housing starts are at recession levels. Permits are at recession levels. This has been going on for some time now. So the clearance rate that you're talking about is too high. Because if it wasn't too high, we would see growing demand, but it isn't. And this has been going on for like 18 months now. And if the builders weren't paying down rates to move the product, things would be even worse. So I encourage everyone, you can go listen to the interview. It was just a few days ago and look at the data right now. Something is wrong here, right? And I've always said the Fed doesn't care about housing because in their minds, it's not part of their dual mandate for the existing home sales. That's fine. I get that. But the housing construction side is, and we're running to what we've always done in decades. This is not anything new. We keep policy too restrictive. We're already down here. And then we go, oh my God, rent inflation is a problem now. We can't get, well, we're already doing something to get that away. So it's just a part of how cycles work. But Neil gives it. Neil Kashkari actually gives us great stuff. When he said 6% mortgage rates, oh my God, how are we supposed to balance the economy with people, buying homes or having sex and having kids? You cannot be afraid to live and build in an economy. If you're one of those people, pack up and go home, go fishing, go read Civil War books. Just getting mortgage rates down to 6% isn't going to change the inflation curve because you don't care about existing home sales, right? It doesn't hit your mandate, so it wouldn't be a problem if it got there anyway, right? Inventory's growing up. We're not at the depressed levels anymore. So I don't know if he's just trolling America, but some of that statement made no sense. And here we are again, housing starts, recession levels. By the time we get anything going, it's going to be a lag. So hopefully we'll maybe see some kind of progress in 2025. But there it is. It's all in that article, and it's very plain and easy to read and understand. Policy is too restrictive for housing. Policy is not restrictive in terms of keeping the economy going, but for housing, it's always been restrictive because sales demand, is simply too low to warrant housing construction, which has been my thing for 14 years, that everyone in the past decade kept on saying, well, we should be building more homes. No, we shouldn't. Back then, we didn't have the right demographics. There was too much supply for the builders. It was the weakest new home sales cycle ever in history. So we had the weakest housing starts. And this is different from every economist's view. But that's how I look at it because that's what the data shows. It's not just me and my forecast for the last decade. I'm saying this is how the builders operate. Why, Sarah?
Because they're not the March of Dimes.
They are not a charity.
They are not a charity.
So,
they're not.
The clearance rate, clearly, I'm questioning that remark with all the data that we have.
So, as you know, I live in a new build community here in Texas. There's a lot of us. I think I'm in an exurb of an exurb at this point. And our builder had a party this week for everybody who has recently moved in or is building or whatever. So I went. Of course, everybody at this party is buying. So it's a biased survey. But we were all talking about the fact that like people from all over the DFW Metroplex are choosing to move here, which is kind of far out, because the builders were giving those incentives, right? It's the buying down of the rate that was really the tipping point. Now, again, it's everybody there made that same decision, but I'm just saying, like, I think it's amazing if the builders weren't doing that and we took that data out, we would be in big trouble.
We would have less production than we have today. Now, thankfully, the corporate profit margins of the builders are over 20%, so they have some wiggle room here. And then we've also had periods where rates fell. When Neil Kashkari was crying that mortgage rates are heading to 6%, that actually helped production of housing because, single-family permits were falling all the way in 2022 until November 9th, 2022 came, and that changed the structural dynamics. So I feel a fight brewing with the Federal Reserve, and the president is not going to be shy about it. So, he should just let me go talk to them. President Donald Trump should just have me go sit down with the Federal Reserve members and have a chat and just go, okay, let's look at the history of economic cycles and let's take Neil's clearance rate and just let's work on something out here, because what they're doing is they're avoiding the question, right? And because they're avoiding the question, they're scared. For some reason, they're scared. I mean, mortgage rates just getting to 6%. This is not 3% or 4%, but 6% mortgage. Oh my God, people might buy homes, Sarah. I'm like, what are we going to do? But the problem is the production side. And I wish the media would actually call them on it. Oh, if I could be part of that Federal Reserve Powell press conference, the questions I would have. But clearly, I think there is some recognition now that, boy, really, we just can't, push this lever too much now, because that's the front line of jobless claims rising, residential construction workers. That usually means manufacturing is getting worse. And there's every single recession we've seen. Of course, we take COVID variable out of the equation. This is why I like to show those charts, showing permits and starts and everything going back to the 1960s. But here it is. This is the world we're dealing with. My job is just to try to figure something out. And I think the main thing for today is really, I think I know the reason why they haven't quite got a Treasury person yet. I think Trump wants kind of like a loyalty pledge on a cap, and then it actually makes his job much easier if you get that. So we'll see by this time. Who knows? Wednesday night, they might get someone. But at least this kind of maybe explains. And here we are, still that tug of war at that kind of the 440, 450 level. And that next move would be really key. So it is what it is. It's a shame we have this kind of mindset here that if the 10-year yield went down to 3.80 or 4%, we could build homes, we could do stuff like that for single family at least. But we just have that hesitancy. And it's just, you don't want those kind of players on your team. At this stage, with the progress that we've made on inflation, the production at this, it's sad. It's sad to see housing starts and permits at recession lows, but it's also something that we've talked about since 2021. Once it happens, don't be shocked.
Don't be shocked. I think you're just the guy to go and talk to the Federal Reserve governors or the president. So I'm for that, Logan. I don't
know if they'd appreciate the chart daddy like other people.
I don't know if they would or not. We'd have to see that. Okay, well, let's talk about purchase apps in the same vein, right? Let's talk about what we're seeing there.
It's now that we have had 1 year worth of data. Oddly enough, if I take all the way from last November kind of 15th in 2023, we have 27 positive weekly prints, 21 negative prints, and 2 flat prints. But now what we've seen is early in the year when mortgage rates were heading up to 7.5%, 14 negative prints, 2 positive, 2 flats, that wasn't working. We don't see the volume declines anymore like we did in 2022. But when mortgage rates headed down towards 6%, 12 positive, 5 negatives, 1 flat, positive trend. You need 12 weeks of positive data to get a trend. That was good. Well, the existing home sales market will come out tomorrow. I'll be on Yahoo Finance talking about that. But now rates have gone up. So what do we see? 3 positive, 3 flats. Nothing dramatically either way, but the pending contracts, I trust everybody, go watch or go read the tracker articles. You can see our pending contracts is staying firmer than maybe some people have believed. Again, every year that goes by, another year of wage growth, another household formation, dual household incomes. You're working from a very low level sales base. So if we see year over year growth in existing home sales, remember October is the mother. How many months have we talked about this? The month of October is going to be the mother of all low bars. So if you see that growth, take that growth in context. But I'm encouraged to see that even with rates going up towards 7%, the pending contracts is still holding up relatively well. And the purchase apps hasn't had that, 1 positive, 5 negatives out of the 6 weeks. So we'll see. It's kind of toward the end. And my thing for the next 6 weeks is, do we get a seasonal push early again, which just means the sheer size of people getting ready for springs comes in early. And that boosts up the demand just a little bit, because last year at this time, mortgage rates went from 8.03% to 6.62%. That gave us about 8 weeks of positive data. We don't have that right now. So it'll be a good test case to see, is this rate level restrictive enough to not have a seasonal demand curve, or do people just wait until January and February and March to start doing that process?
We will have to see for sure. It's interesting. I know that you don't like the term sideline buyers or pent up demand or whatever, but we know they're out there. And you have said recently that you would admit that that's true right now.
So I hate the sideline home buyer marketing gimmick. I hate it. I hate you. Sarah, you didn't know me in the last decade. This was like one of my pet peeves.
Okay, I understand, but there is a truth behind a marketing gimmick.
Yeah. And the pent-up buying theory was even worse. However, even I can change, because home sales have crashed so much since 2022. I am missing 1.3 to 1.7 million home buyers that could possibly be in the pool. So now this is year 3. That's you're getting over kind of 4 million. If it happens again in 2025, you're over 5. So these people did not die. They didn't go down the La Brea tar pits, some alien didn't take them into the sky. They're still there, so we're missing that buyer demand because of affordability issues. Now, if affordability gets a little bit better, I always love this thing where people go, the rates can't go down because housing will be less affordable. I'm like, what? Yeah, home prices will scream. Okay, so you don't want rates to go down because housing will be less affordable. Well, wouldn't that mean demand is negative? And they go, oh, no, rates will go down. You get more buyers. Oh, so it becomes affordable. We do not have functioning human beings when they talk about housing economics. Okay, so rates coming down has always given us a positive demand curve here, even if with the housing affordability issues. And if that occurs again, if we go down to 6% again, and it happens the third time, that we have a functioning model that has been tested enough. So if that, let's just do a hypothetical. Let's say mortgage rates were 5.625 to 6.25 for 18 months. I promise you home sales are growing year over year.
Absolutely.
Right? Because we've seen just a blip of this, and it's given us 500,000 more home sales in 2023 in the early part of 2024. So they're there. They're just waiting, right? And I hate the pent-up demand thesis, but I could kind of make it, if that makes sense to you, that's how I could, agree to something like that. Only because demand has crashed so much, not because I believe there's like people like sitting in the forest waiting for the 10-year yield to get to 9. And they pop out of the trees. And they go, okay, it's time to fill out a purchase application. So.
I love your stories. Yes. Well, I'm glad I got you to admit that there is a scenario under which you think that there are some people who are missing. I'll take that as a win, Logan.
Well, that's better than your fantasy football team, so that'll be good. So that's good. You can take. I'll give you that victory because I feel bad for you. Are you still in last place?
It is terrible. It has been a terrible year. I must say, I've just been very distracted. This has been a very distracting season for me. There's a lot going on in the world, and fantasy football has not gotten my attention.
I don't believe you. Do you know why? Because you were talking trash when I said I'm coming into the league. So I said, okay, you want to play ball? Let's go. And then now it's like, oh, I was here. I just know.
And it's been my worst performance ever in fantasy football. In different leagues, I've won before. This is really bad. So yeah, I'm embarrassed.
Sarah,
bad.
I'm going to give you a little history of Logan Mohtashami. The people that end up talking trash to me before going to war, it doesn't end well. Okay. Because I am obviously committed into winning. Like I hate losing. You want to know why I'm a good analyst? I hate to lose. Do you know why the housing crash doomers are bad? They love to lose, but they just want attention. Like I couldn't do that. It's funny because somebody sent me a screenshot of Nick Gurley, who's the biggest doom porn person in America. I was like, why are you showing me this? This guy's off 62% from his bubble crash call. Like, do you know how bad you are if you're still talking when you're down? So you're off by 60. Do you know how hard it is to be off by 62%? On your national home price bubble crash from 2020, and then home prices are escalated, never went down? No. Some people rather want to look good and lose than some people, I don't care what I look like, I just want to win. And that kind of tenacity every single day. I wake up every single morning with all the time invested in researching. It's just, I'm so much passion to winning, right? And that's an advantage.
It is an advantage.
So next year for fantasy football team, maybe you should just.
Do you think I should be quiet? No, I don't think so. Because I think I should be loud and then follow it up and actually win. That's what I think. This year has just been bad. Okay. Well, we are out of time. Logan, thank you so much for being on. I will talk to you again in a few days.
Sounds good.